Hey, citizens, it's Matt Allen again with Compass Realty here in the DC metropolitan area. I've got some buyers who are really stressed out about interest rates right now because they've gone up pretty drastically in the last few months. And I was talking with my lender, Eric Boutcher, about some other options for people, and he gave me some great suggestions. And what I'd like to do is bring him on to let you know what these are and discuss what some options for you to get into a lower interest rate would be. So without further ado, let's bring him in. Hey, Eric, how are you doing?
Hey, Matt. Thanks so much for having me. I'm doing great. How are you?
Sure, no problem. So interest rates, they're through the roof, as people say, which really isn't that bad, historically speaking. But how does somebody stressed out about not getting the lowest interest rate that they had last year getting into a house?
Yeah, it's a great question. And I think to your point on what you just mentioned at the end there was that, first of all, I think it's all about perspective, right? Interest rates are on the rise, but historically speaking, we're still talking about incredibly low rates on 30-year fixed money. And so I think that what's happening is we are just coming back into a more normalized interest rate environment. I don't think that we're at the top. I think that we're just settling towards more of an average, which we're still well below. So it's kind of reframing that, yes, they're higher than what we've become accustomed to, especially over the last 24 months, but certainly not high historically. Now, with that being said, there are definitely some options that are starting to reintroduce themselves in the market, aside from 30-year fixed mortgages, that may offer more affordable options, such as adjustable rate mortgages or ARMs. So we're definitely seeing more ARMs come into the market where you initially would take an introductory rate that's lower and the rate could adjust over the life of the loan.
Oh, great. So ARM, what does that stand for?
So adjustable rate mortgage. And that'll always have like an introductory fixed rate period. So, you'll typically hear people say a 5-1 ARM or a 7-1 ARM or a 10-1 ARM. And what that means is the first number is typically the amount of time that the introductory rate is initially fixed for. So on a 5-1 ARM, the rate would be fixed for the first 5 years of the loan and then could adjust one time annually thereafter.
Mm-hmm. So when you say adjust, what's the maximum amount that it can adjust up to?
That's a great question. And it's really going to depend on the loan program. So what's really critically important is that the buyers and consumers have very frank conversations with their lender to actually understand the terms of the ARM. But all ARMs are going to have caps and different structures. So we can talk about our company, Atlantic Coast Mortgage, has a set of portfolio adjustable rate mortgages. And one of the products that's offered is a 5-5 ARM. We also offer a 10-5 ARM. The way that would work is the initial rate is fixed for a period of 5 years. It then adjusts and it will be fixed again for another 5 years. And with that 5-5 adjustable rate program, the adjustment cannot be up or down more than 2% from the current rate. So if we say the current rate is 3.25%, after 5 years, in a worst case scenario, the rate couldn't be higher than 5.25%. So when you look at a program like that in this environment, your initial rate at 3.25%, 5 years later, you'd be at 5.25% potentially if it adjusts that high. Your blended interest rate over that 10-year period is 4.25%, which is likely more than a full percent lower than where you would be on a 30-year fixed mortgage. So wow. These are financial tools that can look, 10 years is a long time. Most people are only in a mortgage 7 to 9 years. So that is one exceptional tool that you could potentially use if you qualify to get a lower rate and have a lower rate for a pretty extended period of time relative to current market conditions. So the 10-5 product that I had mentioned, that would be fixed for 10 years, and then it would adjust every 5 years after that, once every 5 years for the remaining portion of the loan, all of these options are still amortized over a 30-year period. So they're still 30-year loans. It's just that your rate is not fixed for that entire duration. But every ARM has different caps. So some can only adjust by 2% at that initial adjustment. Some can adjust as much as 5% on that initial adjustment. And all of them, or almost all of them, we should say, have lifetime caps. So you're regardless of what happens with markets, your rate could never be more than 5% higher than your start rate or 6% higher than your start rate. Mm-hmm. All of these are important things for consumers to talk about with lenders. What's the introductory rate? What are the adjustment periods? What are the adjustment caps? And what are the lifetime caps on how high or low that rate could go?
Mm-hmm. And we're in the first week of May right now, and the average 30-year rate is what, about 5.25% or so?
Yeah, last I checked with Freddie Mac publishes weekly rate surveys every Thursday. So there's so many factors that go into rate. It's hard to pinpoint a single one. But the most recent Freddie Mac weekly rate survey that I saw showed that the average rate for a loan amount below the conforming limit, which is 647,200 in the DC area. So a loan amount of 647,200 or less, 20% down, top tier credit on a non-condo single family home, you'd be at 5.125%, paying 7/8 of a point. So at 0 points, you're probably at 5.375, 5.5. So you're starting to creep into the mid fives, and loan amounts above that limit of 647,200 in some spaces are seeing even higher rates, closer to the upper fives or low sixes in some circumstances. Yeah. And that volatility is continuing as we're talking. The Fed just had another meeting today, and we're talking about future projections. And as those conversations evolve throughout the year with the Fed and rate hikes from the Fed, and what's happening with markets, I do expect that volatility to continue. And as that happens and rates push up, I believe that you will start seeing more adjustable rate products be reintroduced into the market.
Mm-hmm. That's fantastic. And it will be welcome news for a lot of buyers that think they have missed out on a low rate and or may have been pre-approved, 3 or 4 months ago at a lower rate, and now are shocked to find that their money just doesn't go as far as they thought it did.
Yeah, that's a great point. And most importantly, in this environment, especially if any amount of time has gone by, stay in close communication with your lender. Make sure that you are setting expectations properly on current market conditions, because if you were pre-approved at the beginning of April and now we're in the beginning of May, you are likely looking at a very different interest rate environment. And if you were in, March or February or January and you're still looking, you're in a significantly different environment than you were then. So make sure that you understand that and aren't using outdated information when trying to factor in your caps and escalation and offer structure.
Correct. And, with what we're seeing and from the real estate side on the streets is, prices are just not going down because of an interest rate increase with the high demand that we've seen, throughout this year and past few years. And it's not really set to change anytime soon. I think we're going to see high demand for the next few years.
There's no massive amount of supply that's hitting the market. Housing starts are still very low. Resale is, everyone's pausing to put their house on the market because there's not a ton of inventory to buy. So you're 100% right. While, rising rates do certainly have an impact on affordability, and some buyers may pause, demand is so high that until you get significantly more supply, I don't see anything really happening with prices other than you may start to see appreciation level. I don't believe depreciation is going to start happening, especially in the DC market. I think it's more just you might not see your property appreciate 15% year over year like you've seen in recent history.
It's like we've been saying for the last few years now, when we eventually slow, we're going to slow into a normal market of, 3 to 4 weeks to sell a house with one great offer and a buyer able to finally get some contingencies, which they've been not be able to not been able to do for a while.
That will certainly be a welcome day
Yes.
for buyers. But all of that leading to the fact that it still makes it a great time to buy. It's not like it was in 2007 and 8. You're buying at the peak or the apex of a market where the bottom's going to fall out. The real estate market has really never been healthier in terms of everyone is qualifying for the mortgages that they're getting. And, 30-year fixed have dominated it. There's so much regulation. We're not doing loans on stated income, stated assets. So if we do see the overall market, not housing market, but just overall markets turn and there's some kind of recession, it's not going to be caused by a failing housing market. And so it still makes it a healthy time to buy, a very solid investment. You shouldn't see it dramatically turn down.
Mm. Fantastic. Well, and I appreciate your time. My clients appreciate your time, future buyers as well. So with that, we will reconvene in the next few weeks and keep people up to date on any new products that are out there in terms of lending. And I look forward to see you again soon.
Great. Thanks again for having me, Matt.
Sure. Thanks, Eric.
Yeah. Take care.
All right. So that was it. If you think you've lost out on getting a good interest rate, you definitely haven't. There's some great products out there. Eric has got some fantastic ones, and all the other guys at Atlantic Coast Mortgage who do a fantastic job at getting loans done, getting deals done for me and for some of my other clients. So I look forward to talking to you guys soon. Thanks so much. Have a great day.